Don't gamble with your retirement. In this educational episode, I'm going to discuss how to not lose during market crashes. Get ready. This may be new to you, but I don't want you to miss out. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for nearly 5 decades, helping people prepare for a comfortable retirement and protecting their retirement nest egg from the negative impact of taxes, inflation, and market volatility. Those are the 3 big dangers that cause most people to outlive their money. So let's talk about market volatility because a lot of people, when they retire, if they have their money still in yet to be taxed IRAs or 401ks invested in the market, they soon realize that Wall Street was never designed to create predictable income. The market goes up and down and people get nervous. Dalbar, who studies investor behavior, says most retirees, if they just sort of looked at the big picture and would just buy and hold and wait through the market downturns, they might average 9%. But when people see the market dropping down 20, 25, 30%, most Americans go, enough already. I can't afford to lose money. I'm retired. And so they sell low, and then they wait till the market comes back up again, and then they buy high. So the average retiree with money in the market is only averaging about 3.49% according to research. And so that's why the financial services industry came out with what is called the 4% rule. They only want you to pull out 4%. If you're earning 3.5%, and you pull out 4%, you will slowly deplete your retirement nest egg, but not before your LE, which means life expectancy. So that's called the 4% rule. I think that's pretty pathetic because, $1 million nest egg, you pull out 4% or $40,000 a year to net $30,000 after tax. I've earned at least 9% on my max funded indexed universal life for the last 42 years. And so how much more is 9 than 3? It's 3 times. It's 300% more. I'd rather get $90,000 a year of tax-free income out of $1 million nest egg instead of $30,000 after tax. Does that make sense? Well, people say, well, how does this work? Now, let's say you were in a casino or, I'm not really a gambler. I have not put a nickel in a slot machine for probably more than 35, 40 years now. But I find myself in Las Vegas quite a bit because I'm a speaker. And if I were to check into the Bellagio Hotel and they go, Mr. Andrew, you've stayed with us many, many times, and we know you're not a gambler. But we have here a no-loss table, just compliments. If you sit at this table, you can play all day long as you want. And whatever you make by playing at this table, we'll let you keep up to a ceiling or a cap of 12% or 16% or 25%. But that's it. But at the end of the day, if you lose money playing at this table, we guarantee you'll walk out of this room with what you walked in with. You will not lose a dime. Now, I'm not a gambler. I would probably maybe consider playing at that table because that's not gambling, okay? To know that I can walk out and walk out with what I walked in with. Now, what am I talking about? I'm talking about indexing with indexed universal life. We're talking about being able to have your money linked to what the market does. This is indexing. I'm not talking about index mutual funds. An index mutual fund invested in the S&P in 2008, you would have lost 40%. $1 million nest egg would have gone down to $600,000 in 2008, and it would have taken 4 years until 2012 to make back what you lost. And by the way, 2008 was the second time in that decade of 2000 to 2010 that people lost 40%. We call it the Great Recession. People who owned indexed universal life did not lose a dime after the 9/11 terrorist attacks in 2001 to 2003. They didn't lose a dime. They may not have made very much, but they didn't lose. And at the end of 2007, when most people were barely back to break even after 7 years, a lot of people had nearly doubled their money with IUL. $1 million in the year 2000, without adding a dime, was worth nearly $2 million. Well, at the end of 2012, after the market dropped another 40% in 2008 and took 4 years until 2012 to get back to break even $1 million, many of our clients that owned IUL, they had 2.5 to 3 million to show for the million they started with in 2000. Because when the market went down, they did not lose. They may not have made very much, but they didn't lose because your money is not invested in the market. It is safely tucked in an insurance company. And so that million sits in the insurance company, earning the general account portfolio rate at 4 or 5%. Back in that decade, the general account portfolio rate for most of these insurance companies, this is on their general account portfolio, AAA, AA bonds, mortgages on shopping malls and skyscrapers. They were earning about 6%. They need about 1 of those percentage points for their profits. They're in business to make a profit. The net is 5. Any year you feel, bearish about America, you can just settle for that general account portfolio rate of 5% on $1 million nest egg. That'd be 50 grand. But any year you feel bullish about America, you can tell the insurance company, you know what, I'm willing to relinquish the interest on my $1 million this year so that you can use that $50,000 of interest to have the wherewithal to pay me whatever the S&P does or the Dow Jones if the market goes up. Now, you're not authorizing the company to use your $1 million in the market. Your $1 million has to stay safe in the insurance company earning 5. What you're giving up is the for sure 5% interest that year on your $1 million. What do they do with the interest, the 5%, the 50,000? They're buying upside options in whatever index or indices you chose that they offered. If it's the S&P 500, they buy 50,000 of options in the S&P 500. If the S&P goes up that year, that 50,000 of options allows them to pay you 10 or 12%, 100,000, 120,000, 160,000, maybe up to a cap, because options, they can't afford to pay you what the S&P actually does because they don't have your full $1 million. They only have the interest on your $1 million. But if the market crashes, if it goes down, the options expire worthless. But your $1 million is still there. So you don't lose any of your principal when the market goes down, but you make money when the market goes up. So that's why I compare it to like a casino. And I'm not even a gambler because it's not gambling when you have your money in an IUL policy and you get to make money when the market goes up, but you do not lose when the market goes down. Does that make sense? And so that's why that's one of my favorite financial vehicles, using indexing, which is a strategy. And I'm not talking about an index mutual fund. Your money is at risk in the market in an indexed fund. Indexing is a strategy. So if you want to learn more about this, I would love to gift you a copy of my most recent best-selling book. It's called The Laser Fund, which is actually 2 books in one. This white-covered side contains about 200 pages, 14 chapters, with all the charts and graphs and explanations of how to diversify and create the foundation for a tax-free retirement. And chapter 6 on this side of the book talks about indexing, okay? And I can gift you a copy of this. I'll show you how to claim your free copy in just a moment. But if you're more of a right brain learner, you learn by stories and examples, you flip it over to this orange-covered side, and this is about 100 pages, 12 chapters, with 62 actual client stories of how a max-funded IUL using indexing is like the dream solution for all kinds of financial goals, not just retirement, okay? Now, if you want to use both your left brain and right brain, I'd recommend reading both books. It retails for $20 on Amazon. Plus, you have to pay shipping and handling. I'll tell you what. Simply go to Laser Fund, laserfund.com, and you contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost, and I will pay for the book. I'll fire out a hard copy to you. And while you're in there claiming your copy, check out the options if you like to listen and learn or watch and learn. There's audio and video available for a nominal fee. Check out the free webinars we teach on a regular basis. You can even schedule an appointment to talk to an IUL specialist to see how a properly structured IUL can be established for you, and you can see illustrations, because this is an incredible financial instrument that allows you to not gamble with your retirement and not lose money due to market downturns by using this strategy called indexing.